All right, investors, it is time after a short seasonal hiatus from Mike's Market Update. We're back at it. Too many people have said, hey, I rely on those videos. We really like those videos. Break it down for us. So here we're back, a little late in the month of February, but we got a lot to cover, a whole bunch of stuff going on from a macro level. So we may as well actually just call this Mike's Macro Market Update this month. We'll dig into Portland at the end just to kind of run through some numbers and show what that's at. This month, I've included affordability. So I made some affordability projections as affordability has decreased extensively, significantly over the past few months as we've seen interest rates increase. So we brought that into the macro discussion. And then obviously, we've got Russia's invasion of Ukraine. So we'll talk on that a little bit as well. But that being said, let's jump into the macro. So I want to kind of talk about changes. So here's what we're going to talk about today. What's changed and is changing, what stayed the same, because even though we've had a completely different environment from an investment standpoint, there's still a lot of things that are still kind of the same. We'll definitely get into mortgage credit, purchasing power discussion, macro real estate headwinds and tailwinds. So what's helping the real estate market or what's hurting the real estate market, or what can help or what can hurt. Kind of some of my takes. We'll talk about war discussion and again, affordability update. That's important. So we'll look into those numbers. Locally, we'll get into January's numbers. That's what we have now. And then kind of what to expect going forward. So let's roll. So is the sky falling? No, it's not, but we have a very, very, very different investment environment. So what we haven't seen since prior to, and not even prior to, we just hadn't seen inflation for the past decade. And so the discussion of fighting inflation wasn't really around. The discussion for the past 2+ years has been how do we create stimulus? How do we move the economy forward? How do we make it an accommodative monetary policy? And that comes ever since 2019 when we had the inverted yield curve. So in the fall of 2019, we had the inverted yield curve, and then immediately the Fed starts taking action to stimulate the economy. And now, 2.5 years later, the economy is at a point where it's moving so fast, inflation is a concern. And now there's not only discussion of fighting inflation, but bets are being made on how the Fed will fight. And the commentary from the Fed is significantly different. Over the past 4 or 5 months, it's significantly different than what it had been. Even though we've been seeing inflation, even though we feel inflation, we knew that it was coming. The discussion of, was it true monetary policy inflation? Was it supply chain? Was it transitory? So the Fed has completely changed their discussion on what that means and how they're going to fight it. So that's showing up. Interest rates are increasing. So we'll talk about interest rates increasing. No, the interest rates increasing are not from the Fed taking action, because the Fed hasn't actually even taken any action yet. They've just said, here's what we're going to do. Here's a map, what road that we could go down. And then the bond market's reaction to the Fed's discussion is what's affecting interest rates. So we'll look at that as well. We're seeing volatility in every single market. So kind of any market that's out there right now, we're seeing volatility in it, in the short-term markets, excuse me. And we'll talk about that. Ukraine invasion, war, macro money, how it's placing money bets, which it's already happening, and it's interesting to watch. So things that have remained. We're still seeing buying the dip. So one of the outcomes from coronavirus worldwide was the creation of excess capital. And how we know that even though there was bottom-up stimulus, there was direct checks to taxpayers. From the bottom-up standpoint, a lot of it was still top-down, and so that's investment dollars, right? So the central bank creating buying of financial instruments, putting money back into investors' hands, so then the investor can add that money to the economy. That's a top-down trickle effect. And so that's an excess of macro money. And so what's that creating is anytime we're seeing anything go down in value, those are being bought on the dips. The stock market goes down, it gets bought, goes right back up. Bitcoin gets down, it gets bought and goes back up. Gold goes down, it gets bought. So we're seeing buying of the dips continue to happen. Supply levels are still slow, multiple reasons: supply chain constraint, delaying housing deliverables in multiple aspects of goods, in lumber and appliances, delays in just getting permitting done nationwide. So we still see supply chain constraint from a housing deliverable standpoint. We still have historically low interest rates. So even though we're in an increasing interest rate environment, getting relative is really important. We are still historically low when it comes to interest rates. Tight job market. So again, it's the laborer's job market, meaning the laborer has more leverage now than we've seen since the early 1900s when unions started being formed. So really tight job market, really good for laborers, which is good for income, which then also is good for real estate, because if incomes are going up, and we'll talk about this more when we get into affordability, since affordability has kind of been sucked out of the market with this increase in interest rates, incomes increasing is what will be required to keep pushing real estate values up. Inflation in all measures, CPI, consumer spending. What's really interesting, what came out last week was, even though we're seeing inflation, historic levels of inflation and everything, consumer spending was still up. So it hasn't kept the American consumer from spending, which is really interesting, because that's one of the concerns of inflation is, well, if inflation gets too high, now people stop spending. Now we lose the velocity of money moving through the economy slows down, then that starts slowing down all of our economies. So the fact that consumer spending actually increased is actually a really good sign for the market. So let's talk macro rates, yields, and mortgages. And so this is where I like to go. 10-year Treasury note. Here's a 20-year look back. You can see what's happened in the 10-year Treasury yields. So again, it's yields. So the 30-year conventional interest rate it directly tracks along with the Treasury yield. So we don't want to worry about what the Fed's doing to the overnight borrowing rate, the prime rate. We're looking at bond yields. Now, when the central bank, the Fed, talks about moves they're going to make, well, that creates preemptive moves in the bond market. And so we saw that. So here's the coronavirus. Obviously, corona happens, yields just drop out of the bucket. So what happens is, we're afraid what's going to happen. All that big macro money goes for a safe investment. So they move into US Treasury, 10-year Treasury notes. And so the yield, so the price goes up, all that demand, price goes up, yield falls out of the market. So early on in corona, we just kept really, really low yields. We did start seeing an increase in yield, and then a dip, and then an increase again. What's really important to notice is the Fed has been talking for since late summer of 2021 that, hey, we are going to take action. They started hinting at, we are going to start increasing rates in 2022. For the longest time, the conversation was no rate increases in 2022, probably the end of 2023. The conversation started to change in the late summer of 2021, that, yeah, we will have to start making some rate increases in 2022. And that discussion went from, well, will it be 1 or 2 rate increases to, it could be potentially 7 rate increases in 2022. And now they're even talking about potentially making a 0.5 point increase in their March meeting. So the initial conversations didn't really affect yields. We didn't see yields going up. In fact, they kind of stagnated. But this latest discussion of the action they're going to take, they're going to stop their bond purchasing, the mortgage-backed securities, and then the Treasury notes. They're not going to be purchasing financial instruments anymore. And not only are we going to make interest rate increases, we're going to make multiple interest rate increases. And so that's what's created the yield. And I do want to look back in the 5-year look back as well. So 2018 to 2019, here's where we had the inverted yield curve, and that pushed yields down again right before yields got pushed down in coronavirus. The 1-year look back is really interesting. The reason I want to bring this up is, look at that 2%. So kind of 2% is really felt, in my opinion, 2% yield is really felt like a ceiling. So once we break 2%, we broke it in early February, came back down, broke it again, and then we come back down again. And then this is actually a old slide. Do I have another one in here? No, I think I have 2. Yeah, so, and then we have the invasion of Russia. And so now this has come down to 1.9396. And then today it came back down another 13 basis points. Now it's at 1.83. So we kind of hit that ceiling at 2% yields on the 10-year rates. And now we're down to 1.83% today on a yield. And what are we seeing? Again, it's that Ukraine, it's the unknown. It's the scariness, what could potentially happen from a war. So we're talking about inflation. So understanding the mechanics of a T-note. What is a T-note? A T-note is you're a lender to the American government, right? You're buying American debt, which means you're a lender, they are the borrower. What do you not want to be in an inflationary market? You do not want to be a lender in an inflationary market. So immediately we're going to start inflation is going high. We're going to start fighting that. Boom, exit. Money needs to exit out of the 10-year treasury note, the bond market, they exit out. But then shortly comes along fear of war and fear of uncertainty. And so now we need safety. And so now we're flocking back into safety. And so it really feels like potentially we've seen it kind of maybe top out around the upper ones, maybe 2%, maybe a little over 2%. My opinion all along at the end of the year was mortgage rates would be, the 30-year mortgage rate would be in that 4 to 4.25% by the end of the year. And typically we're going to see a spread of the 10-year treasury note yield to the 30-year mortgage rate, a spread of 1.5 to 2%. So if we're in that 2.25% of the yields, and then you add another 1.5 to 2 points to that, now that gets the interest rates into the 4 to 4.25%. So I think we've seen a good portion of the run on interest rates. I do think that they'll still continue to go up a little bit more in this year, and we'll show that in the affordability numbers. But it's interesting now that we have a little bit of chaos in the world, a little bit of uncertainty, then we can see that macro money moving into the bond market. And that may be kind of, a bit of a savior to the marketplace. So 1 year you look back, you can see significantly over the past year is when those yields have come up as money has exited out of that market. Okay, so interest rates here is where we're at based at the end of 2/24, the week ending February 24th, 2022, 3.89%. Do I have a later? No, I don't. And so, so we're right at, if our yields, if we're at 1.86 or 1.83, 3.89, we're at that 2% spread, right? So we've got that 2% spread right now, which when you think of a spread being between 1.5 to 2%, historically, that's what we've seen. If we're at the 2% spread right now, that's a good spread for investors. So you think of investors in the secondary mortgage market, not named the Fed, that's a good spread that allows them to create value, to create profits. So we're already up at there. So in my mind, it really takes increasing in the 10-year yield to put more upward pressure on interest rates. I think we've kind of already run. If you look historically, the yield for the past 2 years has really been in that 1.5 market. It hasn't been up to 2. So part of that half-point bump is just investors saying, in order for us to stay in this investment vehicle in the secondary mortgage market, we need to increase our spread from 1.5 to 2. And now that we've seen that, now it's going to take more increases in the yield of the 10-year treasury note to push those interest rates higher. But we're seeing contradictory forces coming from the Ukraine invasion, which is actually bringing money back into the bond market, which is pushing yields down, which puts downward pressure on interest rates. So it's quite possible that we saw that initial run in interest rates. It's very quite possible that they start to kind of level out as these forces take place. And it is, again, quite possible that after the Fed starts fighting inflation, that interest rates start going up again a little bit, depending on what's moving, what's happening in the bond market activity. But I do think we're going to kind of see a little bit of stabilizing out because of the uncertainty. Again, we still have different variants from Corona. We still have potential war. We have the Ukraine invasion. We have sanctions on Russia. So there is a reason for money to be moving back into the bond markets, keeping interest rates low. Mortgage credit availability. So this is the downside of increasing interest rates, right? So we saw the initial drop in credit availability from Corona when just the flow of mortgages slowed down. Then we had stimulus activity, increase the flow of mortgages, increase the flow of investor interest rates are down, more mortgages are being made. And then again, boom, we kind of had a drop in mortgage credit availability as we start talking about interest, the economy, the Fed starting to fight inflation. So the downside here is we're seeing a pullback of investor appetite, meaning hey, we're willing to lend. We have a lot of borrowers out there that we're willing to lend to. So there's fewer borrowers that are capable of borrowing given the current credit environment. But it is kind of equal to those 2013, 2014 levels. So much better than the 2011, 2012. They're still at a level that creates a functional marketplace, which is going to be key. Okay, so which way are the winds blowing from a macro standpoint? And no, some items do act as headwinds and tailwinds. So you get, it's really kind of tough to see the wind moving forward or kind of the environment moving forward. So we'll just kind of talk about some of those things. So will there be mortgage investors, secondary market demand? So those are those investors, the macro money who invest in mortgage-backed securities. So big groups of mortgages. Who's buying those big groups of mortgages? Not named the central bank, not named the Fed, right? So will that demand still be there? That's going to be key to keeping the amount of mortgage volume flowing. So we had a record number of lending last year. So will we continue to see a record amount of lending or close to record amount of lending, or is lending going to pull back? Because if lending pulls back in the secondary market, or the investment in mortgages pulls back in the secondary market, that will slow down the amount of lending happening in Main Street, meaning the amount of buyers transacting in real estate. And so that could pull demand back. And as we pull demand back from the real estate market, then supply levels go up. Supply levels go up, then values potentially go down, or at least the competition amongst buyers is going to go down. So that's a really important factor of what's going to come into play. And what I just talked about is the spreads for investors has increased over the past month from about 1.5% to a 2%. So that keeps them in the ballpark. We'll see if it will continue to keep them. The Fed will be pulling back from purchasing their MBS. How will that affect the market? Because again, that's a big player. They're buying $20 billion, I think it's $20 billion a month in mortgage-backed securities. That keeps money flowing into the mortgage market. And so we know the Fed's pulling back. So is another investor going to take their place, or are other investors going to leave with them? That's a real key to what's going on our mortgage market going forward. Low supply. So low supply just keeps us from transacting, right? So when you have low supply, keeps competition amongst buyers really heavy. That puts upward pricing on pressure. Pricing on pressure as interest rates are going up will slow down the market. You slow down the market, that then reduces demand, reduces prices down. So low supply helps real estate values, but it also at some point when you get so low of the supply, it hurts transactions. And if you hurt transactions, that puts undue pressure on prices, which then will eventually slow down the market. So it's just a matter of where we at in that cycle, something to watch. So transactional volume low. Construction delays and starts. So that again is keeping transactional volume low. And for a market to function, we need to have transactions. And if it doesn't have transactions and it starts to slow, then it becomes adverse, or at least the forces inside of the market could potentially become adverse and potentially hurt. What could help real estate? Again, low interest rates. We still have low interest rates. We still have really, really good purchasing power. Now, what we don't have, what has run out of the market is refinances. So there was a really good Bigger Pockets episode recently. They had a macro economist in there, and one of the stats she said was something like 70% of mortgage holders, so of borrowers, people that have a mortgage on a piece of real estate, 70% of those borrowers are now under a 4% interest rate. Okay, so they're not going to refinance. Now the interest rates are higher, especially if you're in a cash out refinance world. Now you're 4% or more. No longer the math does not work to refinance. Okay, so what does that do to our market? Well, it makes it easier to get a purchase mortgage, because they, instead of processing refinances, they can now focus on processing purchase transactions. But think of all the money that people pull out of their house and then put into the economy, right? So you pull out 30K and then you remodel your kitchen, pull out for X, then you go do Y. Very rarely do people refinance just to change their monthly debt burden. Most of the time when people refinance, they're pulling cash out and they're buying something. So that potentially has the effect to slow down the market. Not everyone does that, but and again, potentially it does have the effect to kind of slow down our economy to an extent. But again, always stay relative. We're still very low. So this is a very functional interest rate that allows us to borrow. that allows us to borrow and still get a lot of value from that borrowing. So it hasn't devalued credit to too much of an extent yet. Increasing interest rates. So this is where we got our fence jumpers, and we're seeing that right now, where whenever you get a drastic change in interest rates, you see people jump in, right? So, oh, we've been waiting. Oh no, interest rates are going up. My purchasing power is going down. I need to buy now. I need to transact now before my purchasing power reduces so much. So that helps people transact, right? So that helps push volume forward in the transaction portion of the real estate market. We're going into the cyclical selling season, at least here locally in the Pacific Northwest. So demand's picking up, right? Sellers are going to pick up, demand's picking up. So this is the time in the market where we start having transactions. People want to transact. We want to come out of our deep gray sky slumber. Purchasing power is still high, so that will help push that cycle forward. Now, there is concern that the macro may bring more sellers with it, right? So as this environment's changing, now it may make sense for people to start selling, right? In the past 2 years, with interest rates being so low, why was there a reason to sell? You know, you could refinance it, get a really low rate. Our rental markets have been going up the past 10 years. It makes sense to rent it, hold on to that property, rent it, go buy something else. Now it may make sense to start selling. So potentially we get more sellers into the marketplace coming up. Affordability. Let's talk about affordability. So these are October. So this is Portland numbers. Okay. So, but this is the reason I bring this in the macro portion of the market update is because these numbers can be done at any market segment, any market you're in, you can do the same thing. So simple, here's our median income. What's 25% of that monthly income's $2,000, interest rates at 3.14 back in October. Our median price was $510 at that time. So that requires a $100,000 down payment, $408,000 mortgage. That makes your monthly payment based on that interest rate $1,751, which is less than 25% of our mortgage, of our monthly income. It's only 21.25%. So that pushes this number above 100. So if our affordability number is above 100, that means it's an affordable market. If it's below 100, that means it's a not affordable market based on 20% down, Freddie Mac 30-year rate, median income, median purchase price. So this was the October numbers. We're at 114. December, RMLS locally just came out with December numbers, not much changed. Median sales price went up 1,000. The interest rate went from 3.14 down to 3.1. So that actually made affordability a little bit higher. So this reduction in interest rate in December compared to October offset the very minuscule increase in median sales price. So where are we at in February? So this is me creating affordability based on February's numbers. So this is off January's median income. January is also median sales price, interest rates as of February 24th, and then our 2021 income. So income's the same. So that means our 25% of monthly income is the same. Interest rates up quite a bit more now, right? So that's a 20% increase in interest rates, median sales price up another $1,000. So no change in income, really, no change in median sales price, but just that bump in interest brought us down to 1.04. So 11 percentage points from an affordability standpoint. So almost 10%. So affordability was reduced by almost 10% just because interest rates went up 20%. So that's the effect that interest rates have on our marketplace. So now we're hovering around, what's that run line? So as I've talked about affordability over the past few years, well, what have we had? We've had runway. We've had runway for interest rates to go up. We've had runway for incomes to go down. We've had runway for pricing to go up. Now we're running out of that runway, even though we've only seen one thing change. So let's project. So I want to forecast at 4.25% interest rates. I don't think interest rates will get higher than 4.25% by the end of the year. So to me, that's potentially the worst case scenario this year based on where I think we're at. So keeping income the same, median sales price the same, that drops us to 100%. So effectively by the end of the year, we could be out of that runway from an affordability standpoint. Now, it's not the end of the world. This is just kind of one way to look at the market standpoint, but it matters. The more affordable market is to the average borrower, the average buyer, that's the median income earner, the median housing price payer, and a 20% down payment. It just gives us an indication of how that marketplace places going. So what could potentially change in this? One thing I do expect to happen is our income numbers come out in April. So in April 2022, we're going to have new income numbers come out. I highly expect those income numbers to be higher. Here's one of the reasons why. The state of Oregon came out 2 weeks ago. We've got a significant tax windfall. So I think it's $934 million of excess personal tax income revenue for the state. So that's almost $1 billion of state income tax. Our state income tax is 9%. So we're talking about $10 billion more of taxable personal income that the state taxed, creating an excess of $934 billion. And at the corporate income level, it's another $600 billion windfall. So the state currently has an excess of taxes based on estimations. So I do expect our median income number to go up. So what happens immediately? So overnight, once that report comes out, even though in the marketplace that didn't transact overnight, just overnight from a reporting standpoint, boom, we get some runway. So that affordability number will increase. And that allows our median sales price to increase. It allows our interest rates to increase in order to keep it still from an affordability standpoint. So I do, when we look back at February's numbers, I do think that this truly is a conservative estimate. I think there is more affordability in that because I do believe people are making more income now than what this is showing. Okay, so there's thoughts on affordability. Let's talk war. So what have we done? From a physical standpoint, we haven't done much at all, right? We've shorn up essentially Europe's, the UN's Eastern Front. So NATO's Eastern Front, we were bringing forces into Germany, east end of Germany, to kind of help enforce those NATO countries from a physical military standpoint. But really all that's been done is the financial sanctions, and they have been significant. So immediately today, the ruble is down 30% versus the dollar. So from between Friday to Monday, sanctions go in. Over the weekend, the ruble crashes compared to the dollar. So think of it this point. Russia has a lot, they're a strong export country, but they also rely on imports. They need to import goods so they can create products for their consumers to purchase. So think of it this way: American imports now cost Russians 3 times more today than they did last week. So that creates an inflationary environment, a significant inflationary market environment inside the country of Russia, strictly due to just financial sanctions. Just because Europe, the UN, and America all said, we're on the same page here. We do not want you invading Ukraine. We're not okay with this. We may not create a nuclear war. We may not bring troops to your front door, but we're going to start penalizing you and your citizens from a financial standpoint, which is supposed to then create political backlash to then force the leaders of Russia, Putin, to then start making changes. Russian banks lose access to SWIFT. So SWIFT is like the communication device between the secondary banking community. So think of it this way: every single day, there's trillions of transactions that happen at the bank level. All that stuff needs to get reconciled. How do you reconcile that? So you reconcile that at the end of the day through communication of banks, movement of money. Russia's banks are now taken out of that. So if you don't have access to SWIFT, you really don't have access to the secondary banking market. If you don't have access to the secondary banking market, that really affects what you can do on a day-to-day basis for your citizens. So what's happening? Citizens are start pulling their money out of the banks. It creates downward pressure on the value of the ruble. So this is a significant ordeal. On Thursday, it's Wednesday or Thursday, I think it was Thursday, when Biden had his press conference, this was off the table. So America wanted to keep them from accessing SWIFT. Europe was not on board. That changed over the weekend. Europe got on board, and now their largest bank is banned from SWIFT. Russian stock market. So it went down by 1/3 of value the day of the invasion, and then today it doesn't even open. So essentially, their financial markets inside of Russia are no longer functioning. That affects the Russian consumer, the Russian citizen, significantly, and this is all to build political power to start creating political changes. Now, Russia, it's been said for the past 8 years, has been building its reserves in gold, It's been building its reserves to try and fight an expected financial sanctions. Okay, so that's the other thing that's going on is Russia knew these things were going to be happening. So they actually have a pretty large, a lot of their reserves, I think 20% of their reserves were in gold. Some of it's in the Chinese dollar, the yuan. So they've been somewhat preparing for it, but that hasn't kept it from affecting their citizens. And so then what happens when you build that political war, then there's talks of Putin wanting to meet for negotiations on the Ukraine-Russia border. So potentially sanctions are doing what they're supposed to do. Well, we know they're doing what they're supposed to do from a financial standpoint. We'll see what that does from a political standpoint or a geopolitical standpoint. All right, bets are being made. So now that we have an invasion and now we have a discussion of war, potential bets are being made, and they're being made in the favor of the US or the favor of the US and allies. China's in a tough position, right? So China is potentially Russia's biggest ally, but what's the rest of the world done? The rest of the world said, Russia, sorry, we're not on board with this. We're going to have swift and hard financial repercussions for you immediately. So what does China do? Do they then support Russia? I think the biggest concern, the concern for World War III potentially to break out, that only happens if China backs Russia, China invades Taiwan, and then now we kind of have World War III start breaking out. I think the stance that America and its allies have done is really keeps China from really kind of supporting Russia. So we'll see how that plays out. Obviously, we're so early in it, we really don't know what's going to happen. But they are in a tough position of what do they do? Do they bet? Do they back Russia? Do they not back Russia? Bets are being placed on America. We've seen that with the bond movement, money moving back into US Treasury notes, right? So that's the safe haven. Again, what makes America so strong is we are the world currency. We have the biggest military, and the rest of the world depends on our dollar to be a good store of value or a good currency. The rest of the world banks on America to be strong, which keeps our dollar strong and it keeps our position of being the world currency there. So potentially what's happening here is this is just restoring America as the world's currency. I think Corona did a little bit of that. And I think, again, potentially this invasion of Ukraine is just, again, showing the value of America or how macro money likes America, and those bets are being played. Gold's shown its stored wealth value. So we saw gold go up immediately upon the invasion. Buying the dips exists. Check out Bitcoin. I've got some Bitcoin maps to show you exactly kind of how that happens. But what's happened, the Russia stock market crashes and then it doesn't open again. We've seen volatility in the US stock exchange. However, it's other than that initial dip, it's really stayed pretty stable in its value. We've seen volatility, but the dips have been bought. So we're kind of seeing a floor to our stock market. We haven't seen a big crash. We were flirting with correction territory of dropping an entire percent in one day. But then that macro money sees a discounted stock market and they move back into that stock market. So a lot of different ways going on. We're concerned about earnings. We're concerned about valuations. We're concerned about war. We're concerned about inflation. We're concerned about the Fed's reaction to inflation. But what's been shown is macro money likes the American dollar. They like the American credit, so treasury notes, the bond market, and they like the American stock market. So those bets are being made. The threat of war could keep interest rates down. I already talked about that. That's the desire for big money to need safety, means moving into the 10-year treasury note, which then keeps interest rates down. The bigger long-term outcome on this, what really signifies for me, makes me feel really good about being a real estate owner, is US-based assets have long-term value. That's what macro money's shown. I like to watch, where does macro money go? It likes the US. That means US assets are good. That means we have a floor of value, a hard floor of value, and a soft ceiling. So as a real estate investor, you kind of have to be feeling good. The outcome could be a lot worse if you're in a different country, in a different position. That's where we're at there. So let's let's get into this Bitcoin. So these Bitcoin graphs are really interesting. So is it a store of value? Is it a utility value? Is it speculation? So who's investing in Bitcoin? And we've seen a lot of volatility in Bitcoin, up over 40,000, kind of down in the 38,000 range. 38,000 seemed kind of like a floor value for a while there. But why are people buying Bitcoin? Are they using it for a store of value? What I like out of this graph is to kind of see, this is the 5-day graph. So the 5-day, look back, there's the crash. I got a 1-day. Okay, so here's where the invasion discussion starts happening here. You can see kind of that rundown and a dip forming. And initially when on the invasion day, gold went up, Bitcoin went down. So that was kind of the initial reaction. So that's the store of value bet, right? So it's like, okay, oh no, what's going to happen? We know gold's going to be good. So we're going to go to a store of value. We're going to exit Bitcoin, or at least the emotional money exits Bitcoin. So it's not really necessarily being bought as a store of value, but with what's happening in the Russian bank standpoint, now it's like, well, from a utility standpoint, Bitcoin has a ton of value. So if you're a Russian citizen, citizen A has all their money in the ruble, citizen B has all their money in Bitcoin, citizen A cannot access their money, right? The banks are cut off. The value of their rubles gone down significantly. On the other hand, Bitcoin has it. They can access the Bitcoin. To some extent, they can transact with Bitcoin, or they can turn Bitcoin into American dollars. So that citizen B that owns Bitcoin has a lot more utility out of it. So maybe it's not a store of value, but the utility to it is there. And then speculation, I think a lot of people speculate on Bitcoin. That's why you've seen so many new investors speculate to Bitcoin. But what I really wanted to show in these graphs, so the 1 month look back, the 5-day look back, so you kind of have that initial evasion. So the value goes down. So it goes down below 38,000, below down 36,000, where it hadn't been for a while. And then from Friday, this is Friday to Sunday, we kind of have this run up. So we have this dip. There's the buying opportunity, right? We talked about buying the dip. So here's the dip. There's the buying opportunity. And then we see relative stability. And then, sorry, here's Sunday. So Sunday, we see a little bit more volatility, and then kind of another dip. And then what's really interesting, if we look at the 1 day, is this run up really happened after the stock market closed today. So 2:10 p.m. local time, Pacific Northwest, the stock market closes at I think it's 1 or 1:34, 4:30 Eastern time, and then boom, a run up. So after the American stock market changes, a run up in Bitcoin. So I think really what that is there is some speculation there. I think it's some of that's also a buying the dip kind of opportunity there. But it's really interesting to see how macro money moves, again, based on kind of the forces that are moving into place in the market. All right, micro. Let's get into Portland numbers. This has been a long time running. Supply levels, again, way low. So less than a month of supply. What's really interesting here is pending sales will see it drew back quite a bit in January. So those are kind of affecting the interest rates increasing, slowing down transactions is actually represented to some extent in this number. So let's get into these numbers. So active residential listings, this is the inventory left on the market at the end of the month, right? So at the end of every single month, this is the amount of inventory. Ridiculously low amount of inventory, even less. So 2022 here, less than 2021, which was significantly lower than 2019, 2018, 2020. So inventories are at a record low. You're not going to find another point in time where inventories have been that low. New listings. Part of that reason is new listings are the lowest they've been since 2017. Here's 2021 here, where it was kind of in the middle of the fold. I think it's 15% fewer new sellers coming to the market in January this year compared to last year. So sellers are not coming to the market. This is the time of year where sellers do start coming to the market. Super Bowl, post Super Bowl is really a good time. We kind of see that initial kind of pent up demand hitting the market. Sellers want to get out in front of that demand. So I do kind of expect that to change, right? So kind of a flat market or declining market typically from January to February before that normal bell curve. So we're caught in that market. So what's going to happen? Are we going to see an atypical bell curve here? Are we going to see flat? Are we going to see down and then a bell curve? Be really interesting to see February's number that come out in a couple of weeks. That's what I'm really interested in seeing, because now we can actually have a little bit more data that shows how the raising interest rates really affected transactions. Closed sales. So 2022, we actually had a really strong closed sales for a month of January. I think the strongest we've seen in a while. What's driving part of that? Part of that is the discussion we knew interest rates were going to go up. So you go back to when the Fed starts talking about interest rates going up, increasing in yields, it's that fence jumper. So in my opinion, this is that fence jumper saying, all right, now's the time to buy, right? Interest rates aren't going to get any cheaper. My purchasing power is going to go down. I need to jump into the market now. And so we're seeing that in the month of January. And I do expect that to go down in February. Why? Because pending sales are down, right? So here's pending sales, the worst January for pending sales we've seen in a long time. More common. So again, buyers kind of start coming out of that winter cycle in January and February. Well, we're slower to the increase in interest rates has slowed some of that activity down. So we will see that in the number of closed sales that happen in the month of February potentially, which then lowers our absorption rate. So even though, say, the end of month inventory is around 2,000 listings, sellers on the market, say that number doesn't change, but if the number of slow closed sales transactions slows down, our absorption rate goes down. Now our supply levels go up. Supply levels are going up. The competition amongst the buyers is reduced. So that could have downward pressure on pricing. It'll take a significant change. The supply levels are so low right now, being at 0.8 months, that we need to get up to 1.8 to 2 months of supply before that's actually going to stop. Before that's going to put downward pressure on the market or potentially put downward pressure on the market. Right now, buyers are out, buyers are strong. If you are a well-priced home in the great location, you're going to get multiple showings. You're going to get lots of interest. It doesn't necessarily mean multiple offers, although multiple offers are happening. But what we are seeing, and this is a discussion I had last year as demand started to pull back a little bit, is you may not get multiple offers, but you're still going to get strong offers. You could still very well get offers above asking, even if you just have one offer. And the reason being is because competition between buyers is tight because supply levels are low. Once supply levels increase and competition switches from competition between buyers to competition between sellers, that's what will happen effect on values, downward pressure on values. We're not seeing that. I don't expect to see it for a little while. Even though interest rates are going up and potentially pending sales are slowing down, maybe showing an absorption rate slowing, marketing times are still way down significantly compared to last year even as well. So here's our numbers, 14%. So January this year compared to January last year, median sales price is up 14%. That's a cooler market than what we saw in the winter, right? In the winter, not the winter, but the summer, we started seeing stuff in 15, 16, 18%. So still an increasing market. The pace is slowing down a little bit. I still think this is too high. When you look at the overall scheme of things of what's happening, interest rates going up, interest rates going up, less accommodative monetary policy. So a change in monetary policy, even if interest rates level out for the rest of the year, I do think, and affordability reducing, this just numbers too high. We're not going to sustain those numbers. So we don't necessarily see downward pricing. I don't necessarily see a correction coming. I just don't see this happening. We'll skip over to affordability since we already talked about it. And I talked about this, the last market update I did, which was like 4 or 5 months ago. I see us going back to this 2018, 2019 cycle, which is just really level values. So this was when, from a macro monetary policy standpoint, we were about as accommodative to the market as we could be from 2008 to 2018. And as we started to pull that accommodation from the marketplace, so when you started changing monetary policy from being very accommodative to less accommodative, the market flattened down. There's that circle for you. So that's really the environment that we're still in. My opinion really hasn't changed from the fall to today. Even though a lot of changes have happened, I do still think from a macro standpoint, we're going to be going to a less accommodative standpoint. I still think supply levels are low, interest rates are historically low, competition amongst buyers is real. So I don't have a concern about values going down, but I do think that that less accommodative monetary policy combined with where affordability is at now, thanks to the increase in interest rates, we're just going to see a level market. I just don't see our market doing this. I just don't see that happening. It's not, we're not set up that way. But I do see kind of just a flat market and not a declining market. So there you go. Any questions for me? Don't hesitate to reach out. My Instagram handle, rarebird_Mike. Yes, rarebird_Mike, or you can contact me here in our business. So thanks everybody. Thanks for watching. Hope you got some value out of this. Talk to you later.